Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching another episode. I greatly appreciate all the comments and activity on the channel. Certainly appreciate the subscribers. Please comment. Let me know what stocks you want to see and subscribe if you like the content. Today I got a special one for you. We're going to go through Intel Corporation. I think this is one heck of a deal. But first, let me remind everybody the 5 key attributes that we look for in this channel, right? This channel is based on value investing. We look for the intrinsic value of a stock. We compare that to the market price. We look for the delta between the two, and that's the return that we can get. For every stock, we put this through the lens of 5 key attributes. Top line revenue growth, earnings growth as we define by EBITDA. So EBITDA, as a reminder, earnings before interest, tax, depreciation, and amortization. It's a high-level earnings estimate figure. We look for free cash flow growth, a strong balance sheet, and a well-priced stock. Now, I want to reference something. The well-priced stock, you can buy a great stock and overpay for it, and you're not going to get a great return. Please reference my Domino's versus Google IPO video where Domino's absolutely smoked Google and a 15-year return. Why? Because the price was cheap when they went public. So that sixth characteristics of a cheap stock, I'm talking relative to earnings, relative to cash flow, it needs to be cheap. That is one of the key hallmarks of any great investment. All right, enough about what we do. Let's go dive into Intel because I know everyone's looking for it. I'm going to follow this video with AMD and with NVIDIA. So definitely check those out. They're going to be a lot of fun. We're going to try to do it in a mini series, and I hope you enjoy it. All right, Intel. I've gone through the most recent 10K that they filed, and I highly encourage you to download this. You can get it from the SEC's website. It is 200 or so pages of fantastic reading. If the wife wants to go to sleep, read it out loud, she'll be out like that. No problem. But it really is good reading, all right? What it's going to tell you is Intel Corporation's 50% of their revenue is a PC division, and you got another 50%, which is basically a portfolio of autonomous driving, cloud data, AI, kind of black swan events that they all themselves could blow up, be huge. So I like that. Second, the other thing I learned is that the R&D budget for Intel itself is larger than all the revenue for NVIDIA. So Intel really is an absolute behemoth in the industry, and so much so, AMD in their 10K takes at least 3 pages of their disclosure telling everybody how great Intel is and that they're a threat to AMD. So I like that dominance. That's definitely a huge moat, as Warren Buffett would talk about, for how they can protect themselves. But enough about that. Let's look at the financials and we'll kind of walk through this together. Behind me is a decade of revenue and earnings for Intel Corporation. And what you're going to see is they start at $53 billion of revenue, and they grow that over a decade to $72 billion of revenue. Now that's only 3% annual growth, not stellar top line growth. I grant you that, but it is growth, okay? And what I liked about it most is if you go through to the EBITDA, you'll see EBITDA is 24 to 32. That's 5% growth. So they're growing their margins, they're growing the business. Most recently, EBITDA has really accelerated. So when I look at this business, I think you've got a stock that has performed moderately well to basically flat early in the decade, and recently has spiked as they've really dove into cloud, AI, autonomous vehicles, those game changers in the market. And I think they're going to continue to double down on that, and that's why I like what I'm saying. You've got kind of a base that's there, and then revenue that's growing, or earnings that's growing. So you got revenue and EBITDA, both stable, both growing. Let's go look at the EBITDA, the enterprise value and the multiples. We begin with the debt. Now they have a pension, so I've included all short-term, long-term debt plus the pension, and you can see it does grow. They went from $10 billion of debt to $33 billion. But the good point is they have a lot of cash on hand, so much so that I've had to remove some cash in this calculation because it truly is excess cash. Market cap, Again, shares outstanding times price. I add all that together, less the cash, and I get an enterprise value. This is how much you would have to pay if you bought all of Intel debt-free, the entire company. And when we value a company, we think of it as buying the entire business, right? That's the best way to get a value because we're not driven on pricing, we're looking at value. Value comes to the enterprise. Enterprise value $133 billion up to $287 billion, a quarter of a trillion, I like to call it. And what you'll notice here is the EBITDA multiple. So your enterprise value to EBITDA, what's striking here is how low it is and how low it has been for a decade. Look at this, last decade at 6 times, almost 5 times earnings for a company that was doing $23 billion a year at that time is remarkably cheap. Now this has grown up to about 10, maybe about 9.5, but it's sitting at 8, 9 times at the end of last year, averaging 7.7. This is where I think it's pretty interesting. Remember the Domino's versus Google IPO, right? Domino's was trading at 7x. It went forward, gave you a dividend, you reinvested it, and at some point the market woke up and realized Domino's had growth. And the multiple went from 7 to I think it was 26 times, and that expansion quadrupled the price. So I think what's interesting thing here is you've got cash flow. Well, we'll get to cash flow in a second. You've got earnings growth, you've got EBITDA growth, and you've got a low entrance point, which is our 5th key characteristic. So let's keep going. I'll show you debt, right? Debt on the balance sheet is low, even though it's gone from 10 to 33 billion. In terms of earnings, that only represents 1 times EBITDA, meaning 1 times earnings here, EBITDA, they could pay all of their debt level within 1 year of earnings. That's fantastic, not to mention they have excess cash on hand. So when we look at our characteristics, let's review quickly. Top line revenue growth, albeit weak, grant you that, but it is there. Earnings growth is good. They're growing their margin, and certainly recently it has grown. The balance sheet, I think the balance sheet is rock solid. 1 times debt plus excess cash. That's great. And then a well-priced stock. So far, the multiple, in my opinion, looks cheap for a $33 billion company. But let's do this. Let's go take a look at cash flow. Then we'll forecast to see what the return is. All right. Here we go. Where the rubber meets the road, my favorite statement, the cash flow statement. Look at this cash flow. It goes from $20 billion of cash flow from operations to $33 billion. Now that's cash money that they can tuck into the bank, they can dividend, they can buy back shares, they can reinvest in the business. That's fantastic. And it's also in line with EBITDA that we saw, right? You want those two to go in the same direction, EBITDA and cash flow from operations. That growth rate averaged 5%, in line with EBITDA. That's kind of an accounting smell check. If for some reason this should be declining and EBITDA is growing, someone in accounting is playing funny with the numbers. But this looks great. CapEx is very consistent to cash flow from operations, roughly 50% every year, meaning they have plenty of cash flow from operations to reinvest in the business. Debt pay downs kind of up and down as we saw, but total debt is cheap. Free cash flow. Shares, I want you to notice that shares have been declining. Intel has been slowly buying shares over the years, which means if you bought it a decade ago, your percentage is 2% higher. Share price for the yield. That's a strong yield, averaging 8.6%. Currently it's 7%. That's one of the hallmarks we like to see, right? When you talk free cash flow, that is cash money that can be just dividended out or bought back, and that's one of the highest numbers we've seen here in this channel thus far. All right, strong cash flow, I think we checked that box. Let's forecast and see what we get. So I'm gonna take this cash flow, I'm gonna go forward, and I'm basically gonna grow cash flow like they've been growing in the past. And I bring it down to a forecast of basically $10 in free cash flow in 10 years. I use the average, in fact, I give it a market rate. I use the average yield here of 8.6. That could actually be too high. If we normalize that for what we're seeing in the 4 to 5% range, that means that 120 is going to go up. But this is saying you got a $120 price target in a decade from now. let's do the EBITDA forecast and see what we get next. All right, so EBITDA, right, we pick up where we left off last year, about 30 billion of EBITDA. I'm growing at 5%, just keeping constant their historical growth rate, not really changing it. And I get $53 billion of EBITDA. I grow that at an enterprise value at its 7x or 8x, minus shares, I get an $81 price target. Now, before we get to the IRR, I want to show you one key thing. Market multiple expansion. We talked about this before at the Domino's video, and I want to show you what it looks like in real time. So if I take this 7.7, and let's say the market finally wakes up 4, 5, 6, a decade from now and says, hey, Intel doesn't deserve 7, 8x, it's 15x with the rest of the market. What does that do to share price? Forecasted $81. If I change this to 15, that is doubled, right? $160. That will take your IRR and give you that upward hockey stick. Now, there's no guarantee, so we're not going to bake it into our estimate, but it's like that upside that you'd like to see. All right, moving forward. Our two valuations. You got the cash flow valuation, 120. You got the one I just showed you, EBITDA is 81. I'm going to average the two, $100. $100 is our price target in 10 years. Right now, it's at $60 a share. What does that look like at an IRR? So here's our IRR. $60 is our entrance point. We've got our cash flows and an exit value. I'm bringing it all over for kind of a net cash flow for the investment. I'm going to hold it for the decade and exit at $100. I get $111 a share. That is a 17% IRR, which is above market for a decade. A very nice return for a company that is a cash machine, just throwing out dollars here and there, and at a 7x multiple that seems pretty inexpensive to me. Certainly relative to the other tech companies that are trading in easy double digits, some are above 30, 40 times. So for 7.5 times, that seems pretty cheap. That means you'll make 3 times in your money over the decade as a conservative. I think that's a conservative estimate of where they're going to land. Again, if you hit that market multiple expansion, right, your share price is going to go up to, I think we said $180. That'd be a big upside. What else can we do? As I said before, I wanted to give you guidance on where I thought this return could look if the price does decline. Let's say wave 2 comes through. If you can buy the shares at $44, that is a 23% IRR over the decade. We're sitting here at $60, so we're at the $17 range. As it increases, I really wouldn't be buying it. If it's at $80, you're at 12% for a decade, which is below what we want to see for sure. So like I said, I wanted to give you a range of what, if you can find and wait for the stock to hit a target, then do so. And if it lands in this less sub $50 a share range, you're looking at 20% IRR every year for a decade. That is a fantastic investment. I hope you liked this video. My name is Cameron Stewart, CFA. This has been Intel, and I'm going to give it, as far as a rating, I'm going to give it a good, right? Because what do we have? We've got top line revenue growth, check. Earnings growth as we define it by EBITDA, check. Free cash flow growth, yes. Strong balance sheet, yes. And it is well priced at only 7 times earnings, 7.7 times earning. All right, thank you very much. Please comment and subscribe. Bye-bye.